How do professional investors make money when they invest in stores and restaurants like McDonald's, ticker MCD, as McDonald's and many companies are starting to open post-COVID? And when is In-N-Out Burger going to go public? So what we're going to do is we're going to do a very fun live case study here on McDonald's and on In-N-Out Burger. And both companies were actually founded around the exact same year, and both have completely different trajectories, as one of them is a public company, McDonald's of course, and the other is not yet, In-N-Out. So in this short case study, what we're going to do is we're going to learn about investment banking. We'll also learn about fascinating global economics and how to do investment research, as well as growth versus value investing. I'll explain all this in a second. You'll love it. Now, as with all investments, we need to find the primary driver that makes a stock go up or down. Now, in the retail sector and the restaurant sector, it's called same-store sales. And it's crucial to monitor how much each individual store's sales are growing year over year, meaning the growth in same-store sales. Why? Well, because if we just looked at total revenue each year for the entire retail company, then investors might be investing in companies that are opening too many stores at the same time, or making too many acquisitions, or basically taking on too much debt. And so what we always do is we look at what's called organic growth, meaning the growth of each store. Now, let's talk about McDonald's, ticker MCD, as an example, which has grown faster over the years than In-N-Out has, because McDonald's, as with all publicly traded companies, is under extreme pressure to grow or the stock will fall. Now, investment bankers did the McDonald's IPO way back in 1965, and McDonald's was then considered a growth stock, meaning investors that don't care as much about near-term earnings bought the stock and they absolutely loved it. And growth investors want the company to spend a lot of money on growing revenue today, and they worry about massive profitability in the future. It's just the way that growth investors work. Now, when growth slows, what happens is value investors buy the stock and they demand that expenses are cut. And in order to grow same-store sales, when McDonald's was still classified as a growth stock, McDonald's introduced the Big Mac in 1968, then the Egg McMuffin in 1975, then McNuggets in 1983, I'm getting hungry, and then coffee in 1993, and then breakfast all day long in 2015. Now, what movie is this from? Can somebody please get this kid a Happy Meal? The company then introduced delivery through Uber Eats in 2017, which has done incredibly well over the past year because of COVID, of course. Now we understand why at McDonald's they say, would you like fries with that or a Coke with that? Investors care most about the increase in same-store sales. And there's tremendous pressure on publicly traded companies to grow, which is why McDonald's has introduced many, many more products over the past couple decades than privately held In-N-Out Burger has. And I'll talk about In-N-Out Burger very, very soon. McDonald's even makes plastic chairs that you sit on that feel uncomfortable after 20 minutes on purpose. All their chairs are like that, not just this funny one here. But they do that on purpose. They make the chairs uncomfortable in order to increase store traffic and, of course, boost same-store sales. It's all about same-store sales. Now, once revenue growth per store has slowed down for McDonald's, what happened was growth investors sold the stock and value investors who like to buy cheap stocks bought the stock. And then, as a result, management's been under a lot of pressure from value investors to materially cut expenses as a way to make the stock cheaper. Remember, value investors like buying cheaper stocks. Now, over the next decade, I think what we're going to see is that the number of employees per store at McDonald's is going to drop materially as you can use ATM-like kiosks to place your orders. And I've seen these much more in Europe than I have in the United States. Now, we're also going to see much more coffee being sold at McDonald's as well, which investors love because the profit margins on beverages are very, very high. Now we understand why publicly traded retail companies keep trying to sell more products at each store as a way to increase same-store sales. And for example, Costco, which is ticker COST, Costco keeps adding products to its store. And I always joke that if you can't buy it at Costco, then you don't need it. And I actually took this picture at Costco. These are my kids. Yes, you can actually buy these things at Costco. You can buy kids at Costco. I mean, bears, yeah. Isn't that crazy? They sell those things there. It's kind of fun though. That's how I feed my kids. We go to Costco, and then you can walk around and they give you free samples. Kidding, sort of. Okay. Now, retail stores like Walmart, ticker WMT, and Target, ticker TGT, they're so hard to compete with, as is Amazon, of course. And so what happens in the United States is there's a massive shopping day in late November every single year, and it's called Black Friday. Because most retail stores that compete with Walmart are in the red all year long, meaning they're losing money. And then what happens is they break even or go into the black around late November, meaning Black Friday. It's so hard to make money in retail, and profit margins are so small, sometimes 1%, 2%, or 3%, which is what credit card companies actually charge retail companies. And this is why retail companies will accept many cryptocurrencies in the future as payments soon, because with cryptocurrencies, you don't pay the nutty high credit card fees of 1%, 2%, or 3%. It's coming. So how do we do investment research on publicly traded companies like McDonald's? Well, the first thing we do is we visit sec.gov. So let's go here, sec.gov. This is an American website for the Securities and Exchange Commission. Then you click up here, more search options, and then you enter in the ticker symbol, in this case, MCD, for McDonald's, and then click Find Companies. And then you read these filings here. Now, you want to pay especially close attention to what's called the 10K. The 10K is the annual report, okay? And the 10K comes out every year, of course. And you can go back over 20 years worth of 10Ks and read them here from McDonald's. And in the 10K, what you'll find is you'll find all of the risks for the company, as well as the background on the company, and much, much more. Now, the second thing we do, and there's many more steps, but I'll only cover a couple today. The second thing we do when we do investment research on a company is we always go to the investor relations website for that company, because every big company has their own internal department, and sometimes they outsource it. And their job at investor relations at that department is to educate investors, all investors, doesn't matter how big or small you are, on the stock. So do a search for investor relations, McDonald's. And you can even sign up to get emails from McDonald's whenever there's a news release. And you have the same access that the big investors do here as well. So you can read the press releases here. Every time they do a webcast or a conference at a hotel in New York City for investors, you get access as well. We all get access by law. And I'll talk about why in a minute or so. But right here, you can sign up for investor updates if you wanted to. Now, since 2002, through what is called Regulation FD, meaning fair disclosure, every investor on the planet now has access to the same information that large mutual funds and hedge funds do at the same time. So you can outperform mutual funds and hedge funds too if you do the work. I firmly believe that. In fact, since 2002, this is fascinating, mutual fund performance has been awful because of this. And 90% of mutual funds underperform lower cost ETFs and major indexes like the S&P. And if you want more information on why mutual funds are a scam, just go to my website, haroonventures.com, and at the top, do a search on mutual funds, and you'll see a video on that. So how do we do even more investment research on companies than the big investors do, and how do we outperform them? Well, based on my career working at Goldman Sachs and at the top hedge funds, I created my own 100-step investment research spreadsheet which I make available to my MBA degree students so they profit from doing deep due diligence on investing in companies like McDonald's and any other company. Let me show you that very quickly and then we'll move on. So right here, and it's tough to see, it's small, but this is a spreadsheet with 100 steps on how to analyze companies. And the way I've set this up is I ask you many questions based on qualitative research processes, right? Many questions here. Then I ask you quantitative questions, and then financial research questions and whatnot. And all this stuff, it feeds into this dashboard here with this dummy data for Apple here to tell you more information about that company. And you also, out of this, get a one-page report, which is similar to the one-pagers you see in my other courses. However, you also get a 150-page detailed report as well. And so this covers everything there is to know about a company when you do investment research. Again, I make it available to my MBA degree students. Okay. Before we chat about investment banking and In-N-Out Burger, which is fun, let's talk about global economics and McDonald's. Because there's a company called The Economist. It's a magazine, and I can't read anymore because the words are too small. But what they do at The Economist is they use a fascinating concept called the Big Mac Index. And McDonald's doesn't charge the same price for Big Macs in every country. And if we analyze the prices paid globally for Big Macs in every country, then we can understand what currencies should be valued at and how much money gets you in different countries when it comes to burger economics. So this is not a perfect science, but it's a heck of a lot of fun to look at. So what we're going to do is we're going to search together for Economist and the Big Mac Index. So let's go over here. Economist, Big Mac Index. Here we go. Here it is. And what you can do is you select your base currency, US dollar in this case, but select euro, pound, whatever other currency you want to. And then you can find out whether or not the economist thinks certain certain currencies are overvalued or undervalued. Doesn't work for cryptos yet. And so here, if you select the United States, you'll see a Big Mac costs $5.66 in the United States and 3.29 pounds. You can select any other currency. In McDonald's, it costs you $6.48. In the US, a lot less, that sort of thing. So check this out. This is a lot of fun. Again, it's not a perfect science, but it's fun to look at. Okay. Let's now talk about this amazing fast food chain that some of you have heard of in the US called In-N-Out Burger. And In-N-Out Burger was founded around the same time that McDonald's was founded in 1948. So why is In-N-Out Burger so small compared to McDonald's? Well, it's because it's privately held, and investment bankers constantly call In-N-Out Burger about doing an IPO. And it would be the most massive restaurant IPO in decades. It's one of the reasons that In-N-Out is small compared to McDonald's is because they are private. Because when a company goes public, what happens is the investment bankers sell what are called primary, meaning new shares, and the investment bankers sell secondary shares, meaning private investors and employees get a boost in their wealth by selling shares in the IPO. And companies that go public can raise a fortune in terms of making new primary shares to sell to the market through what are called use of proceeds. And they use the use of proceeds to make the company grow fast and open many stores, most likely overseas if it's a restaurant company, like Chipotle did, ticker CMG. Now, if Shake Shack is valued at an insanely high price to earnings multiple, I guarantee you that In-N-Out would be valued at a much higher multiple if it were publicly traded. Because In-N-Out could one day have more stores than McDonald's, that's right. But of course, they need to go public first. Now, there's much more customer loyalty for In-N-Out than you see at any other restaurant company in the world. Yet, most of the restaurants are here in California. And there's a fascinating secret menu at In-N-Out as well. And when I go there, I order off of the secret menu, which is not listed. It's brilliant marketing on their part. I get this protein burger, which has lettuce instead of bread, as I've been on this keto diet for 20 years or so. Now, the unbelievable thing about In-N-Out Burger is that they only have just over 10 items on their menu versus McDonald's, which has close to 100 items on their menu. Yet the same store sales of In-N-Out Burger are twice as high as they are for McDonald's. It's unbelievable. It's a mystery, as the company has a cult-like following and employees there make way more money than they make at McDonald's. And the profit margins per store for In-N-Out are twice as high as even Chipotle's, ticker CMG for Chipotle Mexican Grill. Now, the family that owns In-N-Out has been plagued with personal disasters like the Kennedy family has, and my heart goes out to them. The family's lost family members to drugs, an airplane crash, motorcycle crash, and much, much more. And the woman that owns almost all of In-N-Out is awesome. Her name is Lindsay Snyder, and she's not even 40 years old. And she's worth $3 billion. And her net worth could go up literally 10 times if she took the company public. However, it's not just about the money. It's about 1950s style wholesomeness and faith. Now, Lindsay had drug, alcohol, and many relationship issues, and faith actually saved her. And I humbly believe that we all deserve a second chance, and that the past does not equal the future. And in addition to having Bible passages tattooed on her, if you look at the bottom of an In-N-Out fries container or a drink container, you see references to Bible passages. And perhaps if she took her company public, investors wouldn't tolerate that. You know, kind of like if I ever accepted investors for my company, which I will never do. But I might not be able to express my love for God, and I might not be able to tell my students not to worry about their career stumbles because God already knows what's going to happen. Now, for In-N-Out, it's about wholesomeness and returning to an age of simplicity, hence their menu. Now, Lindsay Snyder is the polar opposite of Ray Kroc from McDonald's from an ethical, that's right, and wholesomeness perspective. And instead of selling her soul or company in the interest of making more money, she has a higher purpose in her life, and I love her for that. And her father passed away tragically, and she said this about her father. When he was sober, he was the best dad in the world. You know, we had our time cut short. And so building a business should not just be about making money. You know, there is a higher purpose, like Lindsay has. And Lindsay said, we all deserve a second chance. And she also said, the things that I've been through forced me to be stronger. And when you persevere, you end up developing more strength. I love that. And I think that if you think with your heart in business first, your mind often follows, as do the profits. So when it comes to same-store sales, instead of asking, do you want Coke and fries with that? In-N-Out thinks, do you want faith and hope with that?